Let's get this trading week started. Live from New York City this morning. Good morning, good morning. Equity futures right now down about 0.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York, coming up, the jobs report opening the door to another rate hike. In the face of the biggest drop in bank lending on record, the big banks on Wall Street prepare to report earnings. We begin with the big issue, Q1 results, up next.
Kick off with the earnings season.
Earnings.
We should see weakening in earnings.
Some softness to the top line, to revenues.
Earnings estimates have already been drastically marked down.
They're still too high. They've got to come down.
There's just continues to be a risk to the downside as the economy slows.
Equities seem to have a mind of their own, but the earnings reset to bring it back down to earth.
We've seen inflation be a concern, then less of a concern, then a concern again, then less of a concern.
The labor market is clearly softening.
Tighter credit environment.
I see no upside in the banks.
Just because they're tech doesn't mean that they have complete earnings resilience.
The bar has been lowered, so maybe companies can indeed beat.
Earnings season might actually be the positive surprise that people are not expecting.
I think we are at this key point.
Everyone's holding their breath about earnings.
Joining us now to discuss Morgan Stanley's Michael Kushner, Zach Griffiths of Credit Suisse. Zach, I want to start with the trades for the brave. You're overweight IG and high yield. Banks, both large and regional. Zach, you've got to tell me why.
We think the stress, John, that you've seen in the banking sector is overblown. And when you think about credit and how spreads have widened out in the financial sector, we think that creates a very attractive risk return opportunity, as we don't expect there to be a systemic issue in the banking sector. And I think if you look at the aggregates from the H8, from the H4 data, there's really no indication that this is a widespread issue. And so we think that to the extent the spread widening has been driven completely by concerns with Signature Bank and Silicon Valley Bank, that creates a very attractive buying opportunity. And when we think about the market broadly, we think that spreads and yields here offer attractive returns. We're not expecting a recession in the U.S. in 2023. We think the market is overpricing that, and so we see plenty of opportunity in the market from here. Michael Kushner, which side of that trade would you take?
Oh, I would say we're a bit more cautious, but along the same lines that the reverberations in the financial sector into bank bonds has been overdone, especially for the large systemically important institutions around the world, particularly in the more senior debt structures of those institutions. And that does seem to be an overreaction, and that the economy still looks overall okay, on a slowing trajectory, but the trajectory still seems quite slow given the fears that the market has.
Torsten Slok of Apollo with some pushback over the last week or so. He said Fed hikes were already cooling the economy, and the latest weekly Fed data shows the banking sector response since SVB is magnifying the speed of the slowdown. In short, the credit crunch has started. Now, Zach, has the credit crunch started or not?
That's the big question, John, and we'll really be looking to earnings later this week to sort of kick off how we're thinking about that. And then I think another key data point that the Fed will be assessing as they get to their May meeting is the senior loan officers' opinion survey. How have credit lending standards changed really in the wake of the fallout? And so we think that you're going to see some tightening of credit lending standards at the margin, but we don't see it as a cause for a major recession. But we think it could be a positive in terms of the disinflationary impulse it will have on the economy. I think inflation remains too high in the U.S. really across all measures, but we do have plenty of disinflation in the pipeline. And so that's what we're focused on when thinking about our call for the Fed. We think now that they've raised rates so much, you have the policy rate near positive territory in real terms, the Fed can start thinking about being a little bit more forward-looking with its policy setting versus the backward-looking nature they've had for the past year now.
Zach, is payrolls and a payrolls report on Friday backwards looking?
In a way, yes. I mean, the data is from the past, and when we think about what the key takeaways from that report are, you are seeing some easing in wage pressures, which I think is very important for the Fed, but the labor market is still tight. So it's not an easy decision for the Fed right now. Of course, the CPI data will be key. I think if you look at the labor market, it's remaining tight, but the Fed is probably more likely to put a little bit more emphasis on the wage pressures easing, and that's going to be key from here. And when you think about the mix of jobs that we've had recently, it's really been focused on this leisure and hospitality sector that's been yet to catch up. And so I think that's something that they'll factor into the decision-making process. But at the end of the day, the labor market remains quite strong, which is in itself somewhat of a problem for the Fed.
We've discussed this so many times on this program, the data dependency of the Federal Reserve. How are they dependent on the data? What data are they dependent on? Michael Cushman, can we talk about that? Zach talked about the H8 data from the Federal Reserve. We're not talking about CPI or payrolls anymore. What's important to them? And can you explain to our audience, Michael, what is H8 data and why is that so important at the moment?
Well, the data coming out of the employment report was backward looking. It was pre all the noise coming from the banking sector last month, and there's certainly evidence that that immigration is improving dramatically in the last year or so, which should help employment growth in the leisure hospitality sector, which should reduce wage pressures in that sector, reducing pressures on inflation going down the road, which should make the Fed happier. But data dependency, I think, is key. The Fed has raised rates an awful lot. We'll have to wait and see the impact, as they're going to wait and see. But the economy is not cooling off that fast, given, on the other hand, that the credit crunch, which is coming, is an unknown. But on the other hand, I would emphasize that I think what's happening to credit availability is part of the slowdown process. If this was not happening, I think the Fed would be worried about what it is going on if the banking sector on the supply side as well as the demand side is not slowing and cooling. On the other hand, the last point I would make is that the household sector and the corporate sector is pretty much close to financial surplus, and they locked in low financing rates in 2022, making it harder for high rates to impact that sector. I think we really have to worry about is the small businesses, and that was about 35% of the economy, which depend upon the banking sector for loans.
That's why the focus on regional bank lending data is so important at the moment, Zach. And to your point, we're going to look out for the bank earnings later this week for some indication as to where this is heading. Zach, if I asked you what's more important right now, the payrolls report that came out at 8:30 Eastern Time on Friday, or the bank lending stuff that we gauged from the H8 data from the Federal Reserve, what's more important to you at the moment?
To me, it's going to be the bank lending data and all of the information that we get from the banks through earnings as we kind of consider where the economy is going from here. That really feels like a big turning point in how the U.S. economy and, importantly, inflation can evolve from this stage. And when I think about the labor market as a whole, I think payrolls was certainly strong. We talked about the easing wage pressures. You're also starting to see initial jobless claims tick up, job openings tick down. And so there are some signs of easing there that I think is important for the Fed, but it's definitely early days. So they're going to be looking for more on that end. But in the near term, we think the bank data is going to be more important when considering kind of the future of inflation and the U.S. economy.
Equity futures right now on the S&P down 0.6% on the S&P 500. A little lighter, softer, negative going into the open, about 23 minutes away. The payrolls beat on Friday followed a string of misses through the week. ADP, ISM, manufacturing and services, job openings data, a whole lot lower than anticipated as well. Might be key the next stop for this debate, CPI, in a couple of days' time.
Yeah, it's inflation week, John, and it is going to be a big week for the Fed because after this week, we're pretty much done with the major indicators that will inform their May 3rd meeting and decision on rates. It is a week filled with inflation numbers. The one you referenced, CPI, comes on Wednesday. PPI is on Thursday, and import prices on Friday. We also have retail sales on Friday, and we've got jobless claims and the Fed minutes. Everybody's going to want to parse those for their feelings on where inflation is going to go from here. And the numbers are probably going to be mixed in terms of the CPI on Wednesday. We are likely to see, according to economists we've surveyed, the headline number fall on a sequential basis, and the core fall only a little bit, which will leave that number higher on a year-over-year basis. And so the Fed will be able to say our job is not done, and they should get cover to keep going. Now, to reference a story that John and I were talking about before we got on here, and we won't go into, the bear is still in the woods, and that is the bank earnings. You guys have been talking about it. It's basically the next 2 weeks, and it's not just, I mean, this time we're not really going to care so much about JP Morgan and Citigroup and stuff. It's going to be all the regional banks, your PNCs, your Keys, things like that. What's happening with their deposits and what's happening with their lending. You can see the big drop in deposits and lending, but that is from the H8 and H4 reports last week, which are referencing the week before. So that's really a reaction to what was happening sort of in real time. Do we see those rebound? We did see deposits at small banks start to go back up last Friday, and if that continues, that will take some of the concern out of the Fed. We won't really know how tight the lending standards get till we get the senior loan officers survey, but we will be looking at their net interest margins and what they have to say, certainly, about what's going on with their credit.
Mike, just to be clear, the senior loan opinion officer survey, will the Fed have that in hand when they make the decision on May 3rd?
Yeah, the Fed will have the data, and several Fed officials have told me they will be able to look at what the senior loan officers are saying. But in general, they don't put it out until the first Monday of the month following the first month of the quarter. So that would put it on May 7th. The meeting's May 3rd. But they should have enough data that they'll get a pretty good idea of what's going on.
You know that everyone wants to hear the bear story now, but we'll have to save that for another day. Mike McKee, thank you. Thank you, mate. You don't want to hear that right now, that's for sure. Two views on the Federal Reserve, one from Citi, another from B of A. A similar view, slightly different though on where they think we're going ultimately, but ultimately for May, they both think hikes are coming. Andrew Hollenhorst of Citi has this to say: we expect the Fed will see a still too tight labour market as adding to the upward risk for inflation and continue to expect that rate hikes will continue to a policy rate of 550 to 575. Still the call from Citi and Andrew Hollenhorst. Mike Gapin of B of A makes it simple for May, from red hot to hot on the payrolls report. In our view, the March employment report keeps the Fed on track to hike by 25 basis points at its May meeting. Mohammed Al-Arian wrote in over email to me just moments ago, and he said this: think of how differently we would react if 1, the Fed pauses in May and continues in this mode for the rest of the year, 2, the Fed pauses and then cuts, or 3, the Fed pauses and then is back hiking again. Under 1 and 2, the Fed looks smart, but 3 would cause even more damage to its strained credibility. So, Zach, I'll go through those options again as you think about May. Pause and continue in this mode for the rest of the year, pause and then cut, or pause and then get back to hiking. What's the biggest risk right now?
I think the biggest risk is that pause and continue hiking. And really, when we were going through our 2023 outlook, that'd be kind of consistent with our stagflation scenario, in which we outline a situation where inflation remains too hot, the Fed pauses too soon. And I think for them to continue hiking, you need to see inflation moving the wrong direction again over the next couple of months. And that's a situation where you have credit spreads probably widening, yields rising, and that would be a particularly difficult backdrop for fixed income. So we assign the lowest probability outcome to, or the lowest probability to that outcome, but we think that would be the most damaging to markets. So we'd agree with Mohammed on that call.
Michael, what about you?
Well, I think that what the Fed is confronted with is what a lot of investors frequently are. You can make a decision where if you buy something and it sells off, you feel silly. If you don't buy and it rallies, you also feel silly. The question is, which one you feel worse on, or which is the scenario is worse. So in the sense that if the Fed doesn't hike rates, and they should, they'll look like they're panicking with regard to the banking sector. They'll look like they're worried about financial stability when things are still hot in the economy. On the other hand, if they hike rates and the economy tends to continue to do worse down the road, they can cut rates. It's quite easy to backtrack from that, as they've done in the past. In 2018 to 2019, they flipped from hiking rates and talking hawkish to flipping to an easy policy pretty quickly in 2019. You can do that again, so that we've seen that multiple times in the past. It's very easy to go from tightening, keep going the direction you're going, and then flip the other way if the evidence suggests it. But pausing and then having to backtrack, I think, is much worse.
If you feel silly in the bond market right now, wait a couple of days and the price will change and you'll feel smart again. Zach, the two-year yield in the last week has been all over the place. At the low, intraday last week, 364. At the high, intraday last week, 4.13%. That's another big range in this bond market, and that's nothing compared to what we've seen over the last month. Zach, a question a lot of people will ask this morning after the data on Friday: where's the noise? Where's the signal? Were the misses last week noise? Was the payrolls beat signal? Or is it the other way around?
It's a lot to digest, John, and the volatility has been eye-watering. I guess it's down a little bit when you consider that range compared to early March, but it's really hard to keep up with these moves and trying to extrapolate that for what it means for the economy. And so I think both can be true. I think you're really seeing a slowdown in the manufacturing sector, and that's kind of a global phenomenon, I'd say, more than just in the U.S., while the services side remains buoyant and you have a labor market that remains sturdy but is also starting to show signs of cracks. So I think that you're seeing a lot of volatility in people's expectation for what the central bank has to do from here. And just to level set, our base case forecast is that we are now in the chill mode of hike and chill that we've been pushing for a while. So we don't expect them to hike in May, but we're really going to be focused on the CPI data. I think if you really get signs that it's remaining too hot, it is expected to come down quite a bit on a year-over-year basis, but we'll be looking at underlying trends on a 3-month annualized basis, what's going on with the goods disinflation story. If we get a hotter than expected print from any of those standpoints, we think that they will have to go 25, but it's going to be kind of a push and pull battle, really consistent with the data that we saw last week.
Hey, Zach, awesome as always. Interesting calls. Zach Griffiths there and Michael Kushner, the two of you. Thank you. Going into CPI on Wednesday off the back of payrolls on Friday. Just got the note from Bank of America on CPI, their preview for inflation in America. The headline, sticky services to continue in the month of March. We'll pick up on that a little bit later. Going into the opening bell, about 15 minutes away. Let's get you some movers. Here's Katie.
Hi, John. Well, let's kick off, of course, with Apple. The big news this morning is that PC shipments declined 40% in the first quarter. That is the biggest plunge among all major PC makers. It's bad news for the chip makers. Look no further than TSMC. Sales missed for the second straight quarter. Just another sign of weak electronics demand. Something we saw also from Samsung. Of course, the news on Friday was that it's cutting its memory chip output. But as you can see, that's actually putting a bit under rivals such as Micron and Western Digital. Both of those stocks higher in the pre-market.
Katie, thanks for that. We'll catch up with you around the opening bell. Coming up next, tensions rising as China conducts military exercises around Taiwan.
I'd be very much open to using U.S. forces to defend Taiwan because it's in our national security interest to do so.
That conversation up next.
I believe in a one-China policy, but I would be willing to fight for Taiwan because Taiwan is a democracy. We've stood with them for decades. I would up our game, and if you don't up your game now, you are going to have a war. I'd be very much open to using U.S. forces to defend Taiwan because it's in our national security interest to do so.
What a weekend. U.S.-China tensions simmering over Taiwan. A U.S. Navy destroyer passing through Beijing waters as China holds military drills around the island nation. Taiwan's foreign minister telling Bloomberg the drills are nothing new, likening them to the aftermath of former Speaker Pelosi's visit last year. All this as French President Macron urges Europe to avoid getting caught up in someone else's crisis. Team coverage starts right now with Bloomberg's Emily Wilkins and Damien Sassa. Emily, has the President, the White House, responded to what we heard from the French leader over the weekend?
So what we know is that the Biden administration has been very much in step with Congress, with Speaker McCarthy over what has happened with Taiwan and China and Beijing. This is really one area, one of the few where you really have bipartisan unity among all the different factions in U.S. politics, that they do want the U.S. to be strong on China, to defend Taiwan, and really has sort of given the blessing to trips, to meetings like the one that Speaker McCarthy had with Taiwan's president, as well as former Speaker Nancy Pelosi's trip to Taiwan the other year. And this is something, even when it comes to legislation, we've seen really, really strong bipartisan support. And I think the question is, at this point, if there is going to be any sort of escalation, are you going to see Congress back that? Are you going to see the White House support it? I think that's a lot of question marks as far as what the relationship looks like. Certainly, the Biden administration doesn't want to escalate there. They want to bring tensions down. They want to keep lines of communication open. But if they do need to escalate things, you have a Congress that at this point is very, very willing to take a very hard and aggressive stance against China and against Beijing.
The big challenge now is to keep European allies on side. Damien, that quote from the French leader in Politico saying, quote, the great risk Europe faces is that, quote, it gets caught up in crises that are not ours, which prevents it from building its strategic autonomy. Damien, we were thinking for a long time about de-risking, moving supply chains away from China elsewhere. How do you think about Europe with regards to that now?
Well, with friends like France, who needs enemies, I guess, right, Jonathan? I mean, I think really you have to take a step back, and what it does is it removes the credibility that the U.S. and EU can stand up to China as a deterrent on Taiwan. It's just not really good, I guess, for optics. So for me, it's really going to, again, fall back to the data. And we have a lot coming this week, Jonathan. We have total social financing. We have CPI out of China. By the way, China, they are the only company whose inflation is running below the PBOC target. So you can expect more cuts ahead because the data out of China, the high-frequency data, the export data is weak, weaker than expected. And in my opinion, they've got no choice but to turn inward to their domestic economy and re-stimulate. And I think we're going to see evidence of that this week.
I should correct something we said at the top of this segment. The Navy destroyer passing through Beijing waters. Of course, they are waters claimed by Beijing, and there's an important difference there. Damien, talk to me about the data going forward from here. The IMF has offered a 5-year outlook for economic growth. I don't know how you offer a 6-month outlook, 3 months, 2 months, 2 weeks, but they've done so. China this year is going to be better than last year. Just by the very nature, they're going to reopen. What's the challenge after this year, Damien?
Well, I think you're hitting on a really good point here. The one area, that I've seen is foreign travel, international travel, which had been off the grid, and it was down to, 9% of 2019 levels just in January. We're now at 34% of 2019 levels today. So it's coming roaring back, and you're seeing that in jet fuel demand and other areas. But you're right, once we get back to those 2019 levels in terms of international travel, domestic travel, mobility, and the like, what comes next? So you look to Taiwan exports, you look to, Japanese exports, South Korean exports. It's weak, and it's declining. The downtrend is there. So that's a cause for concern for, all of the GDP data that you're seeing coming out of China right now.
Damien, thank you, mate. As always, Damien Sasser there. Emily Wilkins on the latest with China and ultimately the story for global growth as well. Equity futures right now down 0.6% on the S&P 500. The opening bell about 7 minutes away. Up next, the morning calls, and later, Q1 earnings season on deck. Why RBC's Laurie Calvasina says the banks are one of the most important signals for the stock market right now. That conversation coming up shortly. 5 minutes away from the opening bell this morning. Good morning to you. We are lower by 0.6% on the S&P, on the Nasdaq down about 0.9%. That's the price action. Here is the morning calls. Goldman removing Norfolk Southern from its conviction buy list, pointing to rising regulatory risks and the potential for weakening margins. Your second call, KBW downgrading Block to market perform, seeing limited upside with multiple headwinds starting to pile up. That stock down another 2.8%. And finally, JP Morgan upgrading Northern Trust to neutral, expecting the recent banking turmoil to boost deposits in its wealth management business. That stock basically unchanged in early trading. Coming up, Q1 earnings season kicking off with the big banks later this week. That conversation coming up next with RBC's Laurie Calvasina. Your opening bow just around the corner with equity futures near session lows. We're down 0.6%. The opening bow 23 seconds away this morning. Good morning to you. Equity futures down 6 or 0.7% on the S&P. On the Nasdaq right now, down almost 1 full percentage point. A bit of weakness to kick off the trading week off the back of some really confusing data last week. A string of downside surprises followed and finished with a payrolls report that looked pretty resilient to me and to others too. Let's see opening bow, switch to the board and get to the bond market. That meant yields higher on Friday and then lower this Monday morning. They rebound a bit from there, 338.87 on a 10-year. In the FX market, euro dollar, weaker euro, 108.53 with negative about 0.5%. Last week though, euro dollar climbing for a 6th consecutive week. Euro strength, euro strength, euro strength, approaching 110 seemingly at one point all over again last week. Crude down 0.2%, $80 and around about 60 cents. Into the session we go there to kick off the trading week. About 30 seconds into the session, we are negative by 0.6% on the S&P. The Nasdaq down by about 1%. One stock to watch at the open, Apple. Q1 PC shipments falling by more than 40%, according to the IDC's latest report, marking the biggest slump amongst the 5 major PC makers. Katie Lyons down in Washington has more. Hey, Katie.
Hey, John. Well, the stock is slumping as a result, down the better part of 2% here at the opening bell. That is actually underperforming some of those other PC makers like Dell and HP, which are only down a few tenths of a percent, respectively. Now, collectively, PC makers as a whole saw shipments drop 29% in the first quarter to just shy of 57 million. That is below the levels of even early 2019. But as you suggested, it is Apple that fared the worst in the latest period, with shipments down more than 40%. Compare that to about 30% declines for the likes of Dell and Lenovo, and 24% for HP. All bad in theory, but Apple by far the worst. This, of course, happening as the demand surge driven by remote work during the pandemic has faded and consumers just pull back on spending more broadly. To put this into context for Apple specifically, we know Mac isn't the most crucial line of business for Apple, made up about 10% of its revenue in 2022. Compare that to 52% for the iPhone. But of course, this slowdown in electronics demand is not just limited to PCs, John. We've seen it show up in the smartphone market as well. All of that not adding up to a great demand picture for Apple and its peers.
The stock down about 1.8% this morning. Year to date, though, absolutely flying. Here's another one that's done pretty well year to date, that's for sure. Tesla announcing plans to build a new battery factory in Shanghai after slashing prices on all of its U.S. vehicles yet again. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, yeah, let's focus on the second part of that news, because that seems to be what's moving shares this morning. You can see that Tesla's off about 3.5% or so as the bell rings. And that's after marking down the price tag, as you say, of all its U.S. vehicles. Again, this is the second broad-based price cut for Tesla this year alone. And this is as the EV maker really attempts to boost demand to align better with supply. We know that Tesla sales have been lagging production for at least 3 quarters. And as you can see from that chart, that dynamic is only getting more dramatic. And remember, we learned last week that deliveries rose just about 4% in the fourth quarter, and that Tesla produced 18,000 more cars than it actually sold. Now, again, price cuts from Tesla, they're becoming more common, and they likely have room to run, John. Compared to peers such as Toyota and Volkswagen, Tesla has much wider margins, which creates perhaps more of a cushion potentially for further discounts from here.
Third round of cuts this year. Katie, thank you. That stock's down 3.5%. We'll catch up with David Welch over in Detroit in about 10 minutes from now. Look out for that conversation. Plenty of Southside commentary on this story. This from Citi, paying close attention to Q1 margins following these price cuts, saying this: an inline or softer gross margin outcome could revive concerns over capacity while placing 2023 consensus estimates at risk. We don't think that outcome is currently priced in, making for a less than compelling risk reward into the quarter under the current macro backdrop. That stock is softer this morning. I want to turn to financials. JP Morgan reporting a little bit later this week. We were expecting First Republic to report on Thursday. Those results will now come on April 24th. An update from the lender over the last couple of days. They did this as well. As a measure of prudent oversight, the board determined to suspend payment of the quarterly cash dividend on preferred stock. Shanali has more. Hey, Shanali.
John, let's talk about the preferred dividend for a second, because we're talking about the cost of financing for banks, that cost going up, and more so when you see moves like this, when you see a dividend suspended here, preferred dividend on a pool of money that amounts to about $3.6 billion in capital for First Republic Bank. Now, remember, this market cap of this bank has fallen to below $3 billion. They've lost 88% or more of their share price over the last couple of months, this year alone. So the question is, before April 21st, what becomes of First Republic, and do they need to shore up more capital in order to stave it through this storm? Because if they don't, of course, that could spell more trouble for the banking industry writ large. Now, the question also becomes for the larger banks, too, how much of the deposits have they taken in from these smaller banks? We know the movement has happened, but we will get a scale here of the net beneficiaries of this move. Again, I don't think that the big banks are out of the woods here until we see some of the pressure relieved from some of these smaller ones. Schwab reporting on Monday. A lot of folks are watching Zion's as well because of its commercial real estate exposure. Comerica also down about 38% on the year. So it still troubles. The question is, has the sell-off been extreme enough to start to get some of these worries out of the market?
Janelle, we're talking about the vanilla banking business, borrowing short, lending long. the traditional banking model. What about the trading business, the Goldmans of this world? The report, I believe, on Tuesday.
Yeah, I mean, Goldman, Citigroup, JP Morgan, they should benefit a lot from these very, very volatile markets in currencies and interest rates, but it might not be enough to stave off a lot of the storm that we're seeing. So far, we've heard executives guide slightly softer trading figures. And again, anything softer than what we've seen in previous years is very difficult because we're seeing the clients of these banks also facing a lot of pressure, which spells a lot more trouble coming into the second part of this year.
Hey, Shonali, happy birthday.
Yeah, thank you.
Thanks for being with us. Shonali Bassett going into earnings later on this week. Let's get to the story in the equity market right now. 6 minutes into the session, we're down about 0.8% on the S&P, and the Nasdaq down by 1.2%. A softer session on Wednesday at CPI. Later in the week, it's about the bank earnings. Lori Calvasina of RBC has this to say. Early indications have been that direct impacts on the banks in question were limited. Secondary impacts may take some time to play out, and we expect to see that discussion pick up. Let's pick up on that discussion right now with Lori Calvasina. Lori, great to catch up with you. Welcome to the program as always. Lori, talk to me about what's changed for corporate America since the collapse of SVB.
Well, I loved the comment that you made earlier in the program, John, about, confusing data points last week. And I think one of the most confusing things about the SVB issue was that if you looked at survey data that was captured right prior to that event, people were starting to feel better. You could see this pretty clearly on the Duke CFO survey and, as well as some of the other corporate surveys, that you were starting to see inflections in terms of their outlooks towards the broader economy after things had already kind of returned to recessionary lows. So you had that kind of positive momentum. People are feeling better, and then just this massive amount of uncertainty dropped on top. And I think that we've been trying to, sort of look for reactions in conference commentary. We did go through a lot of the 8Ks and press releases that came out initially after SVB. It looks like it was a relatively well-managed sort of crisis in the moment of, but of course it's these secondary impacts. And I think that's really what's going to be the focus. Obviously, clients are very concerned about the lending environment going forward. It was already getting worse. How much worse can it really get? I think you're going to really see the sell side community pressure the banks on that issue coming up.
The Federal Reserve barely changed its projections. I wonder if it's too early for corporate America to do anything different. Do you think it is too early for the C-suite to provide a change in the outlook?
I think that they're going to get asked and they're going to have to answer. And how they answer, I think, is going to determine some of the reactions early on. And you'll see other corporations, other C-suites sort of look at that for clues and adapt as we go through. I think that's, one of the patterns we normally see. And unfortunately, the financials are always on the hot seat early. So they do have to take some of the hits early on before the rest of corporate America can adapt. But I'll tell you, John, we've also been watching, not just earnings estimates from the sell side, but we've been watching economic forecasts from the sell side. And for all the talk about how this is worsening the macro outlook, you really haven't seen GDP forecasts budge all that much. You haven't seen recessionary expectations in the U.S. budge all that much. So on the one hand, I think there is this macro uncertainty. People are feeling a little bit worse, but you haven't actually seen it translate into numbers yet. And I think that's interesting. I don't think that this is a question of people being asleep at the switch. I think this is a question of the forecast community really trying to do the work and figure it out, and not quite ready to make any firm conclusions yet, but also not ready to write this economy off.
There's always a big conversation about what we're priced for in the equity market going into earnings season. Are you seeing any signs whatsoever, Lori, that in the stock market at least, this story's stabilizing?
I think it is. And, we spent some time looking at WorldCom and Enron and how, the growth stocks performed, after both of those events. We also looked at the financial crisis and looked at how banks performed after that. And, with the risk of saying things that are a little obvious, you saw the banks continue to be weakened after both the Bear and Lehman bankruptcies, which were telling you that we weren't really close to a bottom. But after we got the WorldCom bankruptcy, growth stocks did really stabilize. And so we've been watching the KBW Bank Index, and it's looking to me, not a technician, but it looks to me like it's trying to hold. If you look at where it's been relative to NASDAQ 100, it's been bumping up against some interesting 2020 lows. The small caps also have looked like they're trying to stabilize versus large. If you look at kind of where they've been recently versus where they were last May when they made their relative low for the year. So I think the stock market's in a little bit of a holding pattern right now. And, John, I think this is important because people keep saying equities are asleep at the switch and the bond market is smarter and the MOVE index knows something, the VIX doesn't. I'm an equity person, so I don't really buy that anyway, that equities are just dumb. But I think that equities are kind of, sitting here trying to digest the information and keeping calm for a reason, frankly.
Laurie, I know lots of people like to say the smart money's in the bond market, and perhaps to some extent it is. But last week at one point, the 2 years in the 360s, then it's north of 4%. We're seeing monster moves every other week, Laurie, in the bond market. What kind of signal can you take away from a bond market moving that much?
So look, I think it's the same kind of signal you would take away from the VIX, and we run all these back tests, and it's always impossible, right, to call the actual peak in these volatility indicators. But what we do know is that when they spike to these incredible extremes, if you just run the math, it's typically a buy signal for equity markets on a 12-month forward basis. And what that is a reminder of is that you do need to keep a cool head during times of crisis and really take advantage of dislocations. So that's really what I feel like I'm seeing, whether it's some of these volatility indicators in the bond market or if we're looking at things like AAI, net bull bears, we feel like we're starting to see signs of extreme stress having returned, which is encouraging us, just frankly to keep calm and carry on.
11 minutes into the session, we are down about 0.7 on the S&P. On the Nasdaq, we're down about 1.2%. Laurie, from a sector perspective, what are you advocating for at the moment?
So we still want to be balanced. I had one client call this a tri-bell approach, but we really want to be in the best of defense, the best of growth, and the best of value. We did reduce our cyclicality a little bit this morning by pulling down financials. Admittedly, we wish we'd done that a month ago. We just moved to a neutral, but we really feel like within cyclicals, energy is going to be your better story right now on kind of a longer term view. We think the case there is just, much more solid. There's too much uncertainty around the financials. If you look within growth, we think consumer discretionary has a big valuation problem, but we think tech valuations are more reasonable than many people realize. And along with industrials, it's the only sector that's back in positive revision territory. Now, we'll see if that sticks, but I do think you saw max fear and max negative sentiment on tech's earnings last year, and we're in more of a recovery mode right now, or at least kind of an initial healing phase. And then I think on the defensives, we actually found that healthcare is starting to look a lot more interesting to us. We'd had some valuation concerns a few months back. Those really look like they're in the rearview mirror. It's probably your most reasonably valued defensive right now. We still like utilities, but it's started to get pricey, so we'd prefer healthcare over utilities. But frankly, John, I think we're going to have a lot more twists and turns. The choppiness isn't done. Still think there's a good chance the October lows hold, but I think it's going to be impossible to really trade all these twists and turns. So we want to have some exposure to each of these buckets going forward.
Well, can we just talk about the characteristics of some of the sectors within those buckets? Laurie, I just wonder, is tech defensive to you or cyclical?
I think that we divide things up into three buckets, but I do think in this particular environment, it is more defensive. And I think that the rate story, the Fed story is really still in play. We've been pre-trading it all year, but I do think it's still in focus for now, just these transitions in Fed policy and technology, kind of classic GICS tech does tend to be your strongest performer if you look at the historical performance of sectors following final hikes and following final cuts, or first cuts rather. It's also one of the strongest sectors. So, whether you're looking for a pause or the start of cuts, it's really something that you should be looking to. And again, I think it was hit so hard in terms of earnings sentiment last year. It really got de-risked from that perspective, at least more so than other sectors like financials, frankly, which only entered their downward revision cycle at the beginning of this year.
Laurie, love hearing from you. You know that. Always enjoy it. Thanks for being with us. Laurie Cavacina there of RBC. About 13, call it 14 minutes into the session. We are lower by 0.6%. On the Nasdaq, down by a little more than 1%. We're negative here by 1.1%. Coming up, more Tesla plants coming to China.
They have the scale that no one else has in terms of from capacity, from a battery perspective. That's really them flexing their muscles again in terms of what you saw with the China news over the weekend.
A conversation next.
This is Bloomberg Z Open. I'm Lisa Mateo, live in the principal room. Coming up, Paul Romer, New York University economics professor and former World Bank chief economist. That's at 4:30 p.m. in New York. This is Bloomberg.
They have the scale that no one else has in terms of from capacity, from a battery perspective. That's really them flexing their muscles again in terms of what you saw with the China news over the weekend. They're starting to build out in the U.S., but the reality is not just for Tesla, it's for Apple as well. I mean, you look at it, that's the hearts and lungs of the supply chain of their production. And I don't really see that changing dramatically in the near term.
Shares of Tesla falling for a fifth consecutive session. It's the longest losing streak of the year so far after slashing prices of US vehicles yet again and announcing plans to build a new battery factory in Shanghai. David Welch joins us now from Detroit for more. Now, David, there's two ways of looking at this price cut debacle. Either one, there's a demand problem. That's the negative way of looking at this. Or two, this is strategic genius. It's about maintaining market share and it's going to hurt others. Which one is it, David?
I think it's sort of somewhere in the middle, John. First off, for the longest time, Tesla's basically had a monopoly on electric vehicle sales. There were a few others out there, but they were low volume and they didn't compete directly with what Tesla had. You eliminate that by bringing out all these new EVs to market from Hyundai and Kia, General Motors now. Ford has some out there, and they're going to have to cut prices just to stay competitive. Their vehicles are still very expensive compared to the average vehicle on the market. The other part of this is that you've got rising interest rates and other things, and even wealthy people buying EVs are not immune to that. Monthly payments can be very high on a $60,000 vehicle. So you put all that together, along with having to get their cars under certain thresholds to meet Inflation Reduction Act incentives, and they've had to cut prices by at least 20% on all four models this year. I do think, to your point, that they are also trying to crowd out some of their competitors and make it tougher for them to make money on these. And they've got the scale in terms of battery and manufacturing of EVs to be able to do that right now. They can't do it forever, but I think they can make life tough for those, let's call them new entrants to the new electric vehicle business, because we can't call them old entrants even though they've been around for hundreds of years.
Well, it's true. David, where do you think the Shanghai facility fits into this strategy?
For the longest time, Tesla was seen as not just a car company, it was a technology company. And those mega packs, it's not about the cars, although it does help them get scale for the batteries they're making for the vehicles. It's about stationary storage to supplement the grid. And Tesla has a solar business. You can't really use renewables that well on the grid without having some kind of storage. It does help, but any power generated for the grid has to be used almost immediately. And you make solar and you make wind power when the sun shines and the wind blows, and you can't control that, and is that when you need it? So what would make renewables really work for the grid is being able to store that energy and use it later. And that's been a part of their business going forward. So they're not just relying on electric vehicle growth. So I think it fits in terms of supply chain. Battery makers like growing volume, they like stable volume, and so having another place to put the stuff you're buying from the battery makers helps them out and gets you guaranteed supply for your cars. And also it's another business that Tesla can grow besides the car business, which is softening up for them.
David, we're going to catch up soon, no doubt. This one getting a ton of attention this morning. David Welch there, 5-day losing streak on Tesla. Over those 5 days, down about 14%. Bear in mind that year to date we're still up by close to 45% on Tesla. Analysts weighing in on this one, including Piper Sandler, saying this: while obviously a headwind for margins, we think price cuts are more problematic for peers than they are for Tesla. Let's talk about that now and get over to Kelly Lyons. Hey, Kelly.
Hey, John. Well, it's certainly not more problematic for peers this morning in terms of the share price reaction, because the losses for Tesla are far steeper than some of its competitors, which frankly aren't even underperforming the broader market this morning. Take a look at Rivian, down just 0.25%, Lucid Group down just about 0.5%, Fisker barely down at all. But in theory, John, yes, this is a competition question for them here, because these price cuts could, as you alluded to, signal that there is a problem with demand, but also could just mean that more competition is coming. Interestingly, though, on the subject of competition, as you were just discussing with David, the plans for the battery plant in Shanghai, other Asian EV battery suppliers actually rallied overnight to the tune of nearly 3%, though Panasonic is a bit of an outlier here, so maybe it's less of a problem in the battery space where there may or may not be the same demand question. Finally, just to put this entire EV stock story into a longer view here, take a look at BI's global EV index. Over the last 5 years, up 153%, but actually down by more than a third since the peak in November of 2021. Is that a case of stocks just running too far ahead of themselves, John, or does that actually just showcase the demand issues that may be coming into this space here?
Hey, Katie, thanks for that. That stock is down by a little more than 4% this morning. The broader market's lower. We're down 0.75% on the S&P. The Nasdaq near session lows. Let's get you some sector price action. Back with us, here's Katie.
Hey, John, well, energy is leading the charge today. You can see that sector up 1.7% on a down day for the index. You look at what's dragging it lower. It's the tech sector off by 1.7%, really offsetting and then some the gains that you're seeing in energy. Let's quickly look at the stocks, though. This index still up about 21% year to date, even though we know chips in focus today after Samsung cutting output on those memory chips.
Katie, thank you. Tech struggling this morning, that's for sure, with the Nasdaq underperforming. Up next, your trading diary. 25 minutes into the session, equities lower, struggling this morning, down 0.75% on the S&P. On the Nasdaq, tech really underperforming here. The Nasdaq 100 down about 1.4%. That's the price action. Here's the trading diary. What you need to be looking for: President Biden heading to Ireland and the UK on Tuesday, plus Fed speak picking up again with Harker and Kashkari. The FOMC minutes and US CPI on Wednesday. Wednesday, a big day for data. Then on to Thursday, ahead of PPI. And another round of jobless claims we get Friday. Earnings from JP Morgan, Wells Fargo, Citigroup to round out the week a little bit later this week. After a big month for the banking system in the United States of America, arguably for many, including Zach Griffiths at Credit Suisse a little bit earlier this hour, many think that maybe the bank earnings more important than what we get from the data from CPI on Wednesday. We'll pick up on that story a little bit later. We'll be down in Washington, D.C. through the rest of this week. Tom and I are going to head down tomorrow morning. From New York, this is Bloomberg.